This is a second quarter 2022 update of the Bell Global Emerging Companies Fund. I'm Adrian Martuccio, the co-portfolio manager of the fund. So equity market volatility did continue in the second quarter, but the weak Australian dollar did dampen some of the decline, with the MSCI World Small and Mid Cap Index down 9.4% in Australian dollars. When we look at some of the macro factors more broadly, there have really been few hiding places in 2022. The first 6 months of the year has seen the MSCI World Index decline by 20.9%, which is the worst 6-month period first half in its history. Inflation has driven up interest rates, and a commonly watched benchmark is the US 10-year Treasury yield, which has doubled to 3% this year, up 150 basis points, which is the highest first half increase since 1994. Inflation's remaining stubbornly high. We've seen recent numbers out of the US, 9.1% CPI for June. Europe is at a similar level, 8.6% as well. We do expect inflation to abate later in the year and into 2023, but for now it will stay high. Fortunately though, consumer spending has stayed strong. The labour market is very good. Wages have been rising, and the balance sheet at the household level is very strong. Although the consumer wallet is being squeezed and they are using up that cash, so there may be some weakness in the second half of 2022. The two best performing stocks in the second quarter were both small mid-cap stocks, one being US funeral service operator Service Corp, which rallied 15%, and also Ritchie Brothers Auctioneers, which is a Canadian-based auctioneer of heavy machinery equipment, which rallied 20%. So both those stocks doing very well, bucking the downward trend of the market. While I was travelling, I did meet with the CEO of Ritchie Brothers Auctioneer, and she really highlighted the excellent opportunity that the business has got to grow revenue in the online heavy equipment auction market through not only growing volumes, but also pricing through a lot of the ancillary services that they provide to their customers. So we continue to see very strong upside in the stock, and it remains one of the larger active positions in the portfolio. During my travels, there were also many key messages that I picked up on from management teams, and the most pertinent being that profit margin forecasts for the second half look too optimistic, and double-digit growth expectations going into 2023 look too high. Inflation is expected to be the major headwind, and as we see the effects of inflation annualise through P&Ls into 2023, that will mean there'll probably be some downgrades to earnings. As we have spoken about previously, we believe that quality companies have far better pricing power to maintain their margins and also give much better earnings resiliency through this type of economic condition. So overall, how do we factor this in from a trading perspective? Overall, we increased cash by a couple of percentage points. We sold 3 names in the quarter, one of those being Finnish packaging company Huhtamäki, which rallied 7%, so it was nice to sell that after a bounce. We bought a Japanese-based eye lens and semiconductor supplier called Hoya, which looked like really good value, and also IDEX Labs, which is a US veterinary diagnostics platform, where their stock price is down more than 50% from the highs of 2021, so we believe we got a great bargain there. In terms of ESG credentials, the portfolio remains having a very strong quality score, which is more than 20% above the benchmark, and has a very good and very low carbon intensity, which is over 80% below the benchmark. So in terms of outlook, as long-term investors, we must look through some of the tougher macroeconomic conditions that we're currently in. We believe that valuations are attractive, especially in the small and mid-cap space, where the index is now trading at a multiple of 13.4 times the 12-month forward earnings. And this is a discount of over 7% compared to the MSCI World Index, and the SMID Index normally trades at a premium. We reduce the risk of declining earnings expectations by holding a basket of high-quality companies that really have shown that history of outperforming in these type of inflationary environments. We have already started to see that divergence in stock performance, where high-quality names are doing a lot better than the poorer quality laggards. Looking a little bit closer at the portfolio, when we look at the leverage, 30% lower in the portfolio. So our companies are not threatened by rising interest rates. Additionally, when we look at the profitability, the return on capital of the portfolio is over 15%, which is more than double the benchmark. So this shows the strengths in the franchises that we hold and gives those companies the ability to raise prices and maintain margins in an inflationary environment. At this juncture, we hope that geopolitical tensions have peaked. Supply chain bottlenecks are beginning to ease, and we are seeing a retreat in commodity prices. The S&P Goldman Sachs Commodity Index has actually pulled back more than 15% in June alone. So this should reduce inflation outlooks going into 2023. So we don't expect that central banks will have to be as aggressive in interest rate increases as the market currently expects. Given that, we do see an uptick of investor sentiment coming in the near-term horizon. So we're quite positive on the equity markets overall and believe that the portfolio is very well placed to outperform during the second half of the year.